and welcome to this episode of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. Well, how are you today? Hope you're doing well, taking a little bit of time for yourself. Today, we're going to be discussing something that is going to impact you, something that's going to impact me, something that's going to impact literally every single person in America. If you've got money in the bank, if you've got money in CDs, if you've got money in annuities, if you've got money in the stock market, if you've got money in real estate, if you've got loans, it's going to impact you. What could it be? Well, today we're going to be discussing if we're going to be washing away the Federal Reserve. That's right. If you haven't heard it, President Trump has made his selection for the replacement of Jerome Powell, the head of the Fed. And today we're going to be discussing Kevin Warsh. And yes, it is a very corny play on words, but hey, it's my radio show. I get to do what I want, right? Well, thank you for being here. If this is brand new to you, if this is the first time you've come to our radio show, welcome to the program. This is something where whether you're watching this on a podcast form, you're streaming this, or if this is something you're listening to on the radio, if you've been looking for a place that you can rely upon good quality, basic, down-to-earth information that's going to help you be more successful in retirement, to pay attention to what's going on in the crazy world that we live in, well, this is the program for you. And hey, I encourage you, come to our website as well, Johnson, W-I-M as in wealthincomemanagement.com. You can listen to past radio shows. You can watch YouTube videos and podcasts. You can even find the whole entire library of white papers that are written to help educate you on financially relevant topics. If you're the type that likes to read, I also encourage you to pick up a copy of my book, The Capitalized Retirement, from any of the major book resellers. So what are we going to do now? What is the next step? Well, the reality is that we know that President Trump has now picked Kevin Warsh as the potential replacement for Jerome Powell. Is it a done deal yet? Well, he picked him, but that doesn't mean that he's actually going to be the replacement just yet. He has to get congressional approval, and we all know that that can drag out. That can go for a very, very long time. But I got to tell you, I'm actually very surprised. Of all the various different candidates that were out there, we kind of would have thought that whoever President Trump picked would have been a major Trump fanboy. And in this case, I'm not going to say that Kevin Warsh is not a fanboy of President Trump. However, we're going to be looking at kind of his record. We're going to be looking at where he stands on many important issues of the Federal Reserve. And I have to tell you, it is surprising what he stands on as principles and what he stands on as facts as an economist. So as we get into this, why does this impact you? Well, I want you to remember, even if you really haven't been paying attention to the financial market until more recently, what we have lived through as Americans financially in this country over the course of the last 25 years has been nothing short of exciting, bonkers, crazy, you name it. It's a roller coaster ride, and you know exactly what I mean. It didn't start in 2000, however. It started really all the way back in 1996. 1996, really in 95, we have kind of the advent of the internet and technology starting to take the world by storm. And we watched as the stock market got excited over the possibilities, what was going to happen. We saw the stock market go to new highs literally every single year. And it seemed for a while there that there was just no end in sight. It was going to go to the moon this time. It was going to be different. But was it? And you know the answer to that as well as I do. Even if you don't remember what happened in 2000, you probably remember the term, the dot-com bubble. And you know what? You and I, folks, you and I, we are responsible for what happens in the market. Now, it's not just you, it's not just me, although I do have a client that he pretty much swears that he's the reason that the stock market got broken in 2008. But the reality is that, well, guess what? It is a collective movement. If there's a lot of optimism and there's a lot of buying going on, what direction does the market go? If you answered up, you're absolutely correct. But in the same way, if all of a sudden there is a lack of optimism, in fact, there is fear, there is anxiety, there is caution or nervousness, and there's a lot of selling going on, which direction does the market go? And it is the opposite direction, right? That's when times are scary. Well, if we've been paying attention to what the Federal Reserve has done all throughout the various different crises and the various different, expansions and contractions that our country has had over the course of the last 25 years, we know that there is two things for a fact. Number one, our country has grown very, very addicted. Our economy has grown very addicted to low interest rates. And number two, our stock market, our economists in this country have grown very addicted to the Federal Reserve, paying attention to what the Federal Reserve says, paying attention to where the Federal Reserve goes, making trades and buying or selling based upon the sentiment of which direction we feel the Feds are going to go. In fact, we even have phrases that are quite cliche, phrases like, you can't fight the Fed, right? Well, in this particular case, this is what makes everything so relevant to you. You see, if we're going to have what Kevin Warsh would refer to as a regime change within the Federal Reserve, when he believes that as the now chair of the Federal Reserve, he's going to take the Federal Reserve and he's going to advocate for changes in policy. He's going to advocate for changes in structure and how they make decisions and how transparent they are with the public, and he wants to see interest rates either go up or go down. Well, my friends, that's going to affect you. It's going to affect me. It's going to affect how we buy cars and what stocks we buy. It's going to affect the stock market, and that's going to have an impact on the wealth effect. You see, if you've never thought about the importance of the Federal Reserve, just how important, how much of a factor they are within the world of investing, the world of the stock market, well, I need you to be thinking about it right now. The Federal Reserve is a very, very important factor. So let's get into this. A few facts, number one, about Kevin. Number one, he is the single youngest Fed governor that was ever elected to a position. He was elected to his position under the Bush administration, and he actually served under Ben Bernanke. We remember the crisis that Ben had on his hands when we were going through 2007, 8, and 9. It was the banking crisis. It was the housing crisis. We saw the S&P 500 lose over 50%. It was a scary time. In fact, it's interesting to me as a financial advisor and a fiduciary, when I talk and discuss, and I ask the question, what financial crisis do you remember taking place in the stock market? I'm going to say that at least 7 to 8 times out of 10, most people have forgotten about the dot-com bubble. Most of them still, however, remember the pain. They remember the fear. They remember the anxiety of 2007, 8, and 9. It was one of the greatest, worst corrections in our stock market's history. Certainly not as bad as the Great Recession or Depression of 1929 and the market melting down then, certainly. But it was pretty bad for our time frame, and for the fact that the market had grown as much as it had and the wealth of the market had increased to the size that it was. Losing 50%, well, that was painful enough. That ended up taking thousands, hundreds of thousands of Americans and making them sideline their idea of retirement. So I would say that Kevin Warsh has had experience within the Federal Reserve at a very young age in one of the most critical and one of the most devastating markets that our country has ever had. Is that good news? Is that something that makes him, shall we say, more educated, something with a little bit more feel, a little bit more experience than some of the other candidates that President Trump had to pick from? I guess that's a decision that you're going to have to make for yourself. But either which way, keep in mind that during that Great Recession of 2007, 8, and 9, during that work that he did under the current Fed chair of Ben Bernanke, well, he ended up capturing the nickname of the financial market whisperer. It turns out he's a pretty good negotiator. Turns out that he was able to negotiate deals when other Fed governors just couldn't get it done. This is something that is very important when you're working in the financial market and you're certainly the head of the Federal Reserve. Not only do you have to have candor, not only do you have to have discretion, but you have to be able to negotiate. You have to be able to make certain that people can see things your way. You know that you carry such a big stick that if you say the wrong thing or you make the wrong gesture, you can send the market going in a tailspin of a direction. This is one of the reasons why the second half of today's radio program is going to be so important to you, because we're going to be looking at how does he stand with the Federal Reserve? What does he believe that the Federal Reserve should do to clean up its act, or anything at all? Sit tight. This is something that is going to impact you and that you need to be aware of if indeed he becomes our next Fed chair. Sit tight. We'll be right back. And welcome back to the second half of the Capitalized Life and Retirement Show. I'm your host, Matthew Johnson, president and owner of Johnson Wealth and Income Management, a retirement income source located in Clear Lake and Humboldt, Iowa, serving clients in northern Iowa and southern Minnesota. If you're just joining us, welcome to today's program. Today we're discussing if we are going to be washing the Federal Reserve away. We all know that President Trump has made his pick. He has made his selection for the replacement of Jerome Powell, who as of late has been headbutting with the president over lowering interest rates. And we know that his tenure is going to be coming to an end, and we know that there was going to be a replacement that was maybe going to be somewhat more friendly to the direction of travel that President Trump wants to see this economy go. And so out of all of the candidates, I have to say I was personally pretty surprised, and I think many economists were quite surprised by his pick. Now, Kevin Warsh, as we found out in the first half of today's program, was the youngest Fed governor at the age of 35. He served during one of the most critical pullbacks in stock market history during 2007, 8, and 9, serving under not only President Bush, but also Ben Bernanke. And so he got to see kind of the worst of it. And I think that that's quite actually good. We want to have experience in the Federal Reserve. We want to see what happens when there are shenanigans within the financial world that are being covered up, that are not being paid attention to, when there's not enough regulation and enough inspection on these financial institutions. So I think that that's good. However, in this particular case, now we need to start getting into where he stands. It's interesting because, well, I would have thought that President Trump would have picked someone a little bit more dovish, someone who would say, yeah, I'm easygoing when it comes to cutting interest rates. Yeah, I agree that we want to run the economy a little bit hotter. We want interest rates to go down. Yeah, let's get that economy supercharged. But in this particular case, it's quite interesting because Kevin does not agree with that. Kevin does believe that cutting interest rates should be done. He does believe that the Federal Reserve has been too late to the game in cutting interest rates. And of course, we all know President Trump thinks the same thing. That's why he calls the Federal Reserve too late Well, actually, he just says Fed, the Federal Reserve, Jerome Powell was too late. He calls him too late Powell. But the reality here is that Kevin believes that we've got to be able to see at least 225 basis point rate cuts by the end of 2026. Honestly, I would think regardless of who President Trump picked, that probably would have been the case. So in this case, that doesn't seem too out of line. Otherwise, it's interesting because Kevin is more hawkish. He believes in small government, he believes in a small reserve, and he believes in making certain to dial in inflation using higher interest rates. Now, here's one of the areas, however, that's going to affect you and I. He wants to be able to trim what he calls a very bloated balance sheet. $6.5 trillion of assets the Federal Reserve has. And in this particular case, he believes that the footprint of the Federal Reserve is just far too big. He believes that the Federal Reserve has opened itself up to a number of problems. Primarily, it has created this dynamic where it prevents or it's creating monetary dominance. In other words, the markets are relying too heavily on the Federal Reserve and what the Federal Reserve says. Now, I've shared with you multiple times in this radio show before that the Federal Reserve doesn't have to really do anything. They just have to somewhat maybe give an indication of the direction that they're going to go, and the market will anticipate that at least 3 to 6 months in advance and will take action based upon where they think that the Federal Reserve is going. But see, here's the thing. That's demonstrating exactly what Kevin is suggesting. Markets rely too heavily on the central bank for support. So in other words, think about it this way. Think about, and I know that this is not going to be a perfect example, but I want you to think about maybe swinging on a rope from, say, one side of the mountain to the other side of the mountain, and underneath there's a safety net. So even if you botch it up, you know you're not going to die. Well, the reality is that the Federal Reserve has become a bit of a crutch within our economy. The Federal Reserve has become that safety net to corporations and to financial businesses and corporations. And you see, even if they muck it up, they've come to rely upon the fact that the Federal Reserve is going to bail them out. What did we call it during 2007, 8, 9? We called them bank bailouts, right? The Federal Reserve came screaming to their rescue and bailed them out. So, I would agree. However, have you ever known any time we go to trim back any social programs, anytime we go to trim back the bloat, is it taken with peace, or is there always pushback? Is there always revolt? Is there always some sort of a coup that comes as a result? And I'm here to tell you, if Kevin becomes the head of the Fed, if he decides to tackle this bloated balance sheet of the Federal Reserve and he begins to force them to sell off assets that they have, my friends, that's going to have an impact on the stock market. And not likely a good one. It's going to mean one that creates greater volatility, greater uncertainty, and that could be the beginning of a pullback within the stock market. Now, here's one other thing that's so very vital. I can tell you that after a Federal Reserve meeting and a press conference, economists, journalists, financial advisors, CFOs, CFAs, CEOs are taking those notes, those dictated notes from every single word of that press release, and they are scouring it. They're reading between the lines. They are looking for guidance. And one of the other areas that Kevin Warsh does not believe in is how much forward guidance the Federal Reserve has in light of the general public. In other words, he believes that they say too much. They have created their own prison where now they say one thing and now they're forced to deliver on the good because they said something. And now the public is holding them accountable. When you give any indication that interest rates are going to go up, well, guess what? You're setting the expectation with the market and all those that invest in the market that interest rates are going to go up. That's a direction of travel, and that's what we expect you to do because you said you were going to do it. Conversely, if interest rates are to go down, well, guess what? We are anticipating that you're going to deliver on what you say. We're going to make trades based upon that. And so, my friends, this is going to likely lead to greater volatility in the future. This is likely to lead to a bit of upset until the market gets used to maybe a new way of doing things. The Federal Reserve shrinking in size, the Federal Reserve not having as many dealings, intimate dealings with the market and with businesses and corporations and banks. It's going to have an impact on the market when the Federal Reserve just simply comes out and does things without explaining the reasoning, without giving a telegraphing of the direction of travel. Now, you see, this is why it affects you. Today, literally everything in the stock market, whether it's growth funds, growth stock, things that are more safe and secure like fixed income, everything that is within the stock market is going to have some sort of an impact on the Federal Reserve. And the impact will have, well, extenuating circumstances on retirement. So it is important that we pay attention. It is important that we know who the head of the Fed or the next head of the Fed is going to be. And I'm curious, is your financial advisor, are the advisors that work for you, the advisors that you are paying, are they careful to watch? Are they careful to consider? Are they careful to analyze how a certain call or a change of regime, a change of policy, how that may affect you when you are at your most vulnerable stage? Maybe you're within that period of time of 3 to 5 years and you're about to retire. Why do I always bring that up? In fact, a listener just recently became a client and he was so impacted by the 5-year time frame, but he wanted to know why. And I said, because it's simple. You see, when the stock market declines, well, that's scary. It's unpleasant. And yes, it can railroad a retirement. But you see, you don't have to just be worried about the downside. You've got to be worried about the length and the duration of the recovery. Because when you think back to that tech bubble burst of 2000, the stock market lost 50%. The S&P went down by 50% in 3 years. That took most people's breath away. But then it took 4 years to recover from. My friends, that's 7 years. Now, you could say to me all day long, well, this time it's going to be different. But let me ask you, do you even want to spend a year or 2 or 3 years from now having the same amount of money as what you have today? Are you telling me that you don't mind going through the contractions and watching your balance sheet shrink at the same time that you want to be retired? You don't want to see the value of your shares dropping, that you're going to have to sell in order to get income because no one's told you how to create income the right way through interest and dividends. Do you really want that? Now, certainly I'm not telegraphing or forecasting that that's what's going to happen. But my friends, we all know one thing. The stock market doesn't like surprises. And so if it thinks, well, things are at an all-time high, it'd be nice to take the winnings off the table. My friends, this regime change in the Federal Reserve may just indeed be the catalyst that the market has been looking for to do exactly that. Are you ready? Are you prepared? Are you willing to go through that kind of volatility? If not, I encourage you to get with a fiduciary. Have your portfolios reviewed and safeguarded. I'm Matthew Johnson. Thank you so much for listening and watching. And remember, it's up to you to make today a great day.